So hi guys, welcome back again. So it's another Code on Tap podcast. I think it's episode 25, 23.
23, is it? That's a lot. I didn't realize we've done so many.
Yes, mate. We're going through them. We're going through them.
Oh,
so this one's going to be an interesting one, actually.
Is it? Why is that?
Because it's something that a lot of startups face.
Yeah.
The problem with starting a startup in a regulated space.
Yeah.
It's difficult. Yeah. Because I mean, the thing is, because with a startup, you've got loads of blockers anyway.
Yeah, you do.
And without the space that you're being regulated as well, that is just like, why would you do it?
Right. Yeah.
It's like, first of all, it's hard enough doing a startup. So why would you attempt to start a startup in a regulated space? So I think this is an interesting one because if there's usually what we say, if there's a problem, there's an opportunity. Yeah. And especially if that problem is a problem that is associated with also a market fit. Yeah. So I think it's a good one for us to explore this week.
Yeah, definitely. So why would you build a startup in a regulated space? So I did build a startup in a regulated space. So Neighbor was an online lending startup, and so we were regulated by the FCA, so the Financial Conduct Authority. And you have different regulators depending on which sector you work in. Contrary to common belief or popular belief, most companies, most sectors are regulated in some way, right? It's just how far do you have to go to appease that regulator, and are there specific requirements you need to meet, or specific permissions that you need to get to be able to operate within that sector? Okay. So you can be a fintech that doesn't need to be regulated if, for example, you have a technology platform that just enables activities and doesn't hold client money, doesn't provide advice or guidance or anything along those lines. It's simply an enabling tool. But one of the key things about why would you operate in a regulatory space, sometimes because you have no option. If you want to build a product in this space, you need to be regulated, right? But the other thing is that regulation creates barriers to entry. It increases friction. These are all things that, by the way, are done to protect customers. So I'm not saying they're bad things. I'm just saying what the impact they have. Those are all opportunities to create growth and generate revenue. If you can overcome those barriers, if you can solve for some of those frictions, there's an opportunity for you to generate growth, as well as creating potential barriers for other people to overtake you. So one of the questions we always ask when we look at a startup is, what is your USP, your unique selling points? What barriers are there to other people just doing what you're doing? What are the defensive moats around your business that means some other company won't be able to just overtake you? And actually, regulation can be a really critical piece to that, because if that regulation is particularly onerous or challenging, it may just be too much work for other startups to attempt to do the same. We saw this in the peer-to-peer lending space. That was a wild, wild west, unregulated. Then the FCA decided they want to get their hands around it, and pretty much no one could start a peer-to-peer lending company for a period of time until the FCA decided exactly how they were going to regulate it, and they put in a series of protections, hurdles, and barriers to stop anyone from doing it.
An interesting point you raised there is because presumably then if a particular space is onerous, and your startup has surmounted those barriers, that could potentially make you attractive.
Absolutely.
From an acquisition perspective.
Absolutely.
Because the person doesn't want to go through that pain, and you've done it for them.
And it's a common approach for companies who are looking to grow into international markets, to acquire businesses who already have the regulatory permissions
in that market
that you require in that market. Exactly. So you might be a financial services firm in the UK. You want to expand into, let's say, the US. So you find a company in a US state that already adheres to their FDA regulations, for example. I think FDA is food, but SEC regulations. Securities Exchange Commission, and you buy them.
Mm.
And by doing so, you now have those, well, not your core entity, but you own an entity that now has those permissions, and you can operate in that space. So it's often an approach that's taken. So having those regulations, or so having those regulatory permissions can act as a value add to your business, or even in some cases, a minimum floor to the value of your company.
Yeah, which is good.
Which is a useful thing.
So tell us a bit more about Neighbour, because that journey, that was an interesting journey from the start. And how did you approach being regulated by the FCA in that space?
Yeah, so it was difficult for us because we initially wanted to be a peer-to-peer company, which was one of those newly unregulated spaces. And the way you got into it, there was I can't remember the name of the authority that existed before the FCA. The FCA was a fairly recent invention, but there was an organization before that that took care of all of this. And you could actually get your permissions fairly easily, depending on which box you ticked on the form. But then when the FCA took over, they basically reassessed all of this and decided they were going to put all the peer-to-peer companies through their paces, as it were. So you had to transition your permissions from one to the other. And so we had to work very, very closely with the FCA in order to understand what were the requirements, how might those requirements change. And the thing about regulatory bodies, they rarely tell you what you need to do, right? They'll just tell you, these are the regulations. And then it's up to you to figure out what is it that you need to do to ensure that you won't get fined because you've breached some of those regulations. So they won't tell you that what you're going to do will breach the regulation. They'll just tell you this is what the regulation is. But then later on, if you get an audit, they will then tell you you have breached the regulation.
You haven't done
X, Y, Z. So you have to be very, very careful. I think one of the things that benefited us as an organization actually is we went through an audit by KPMG very, very early on to our growth experience. And that was largely because one of our anchor clients, an organization called Police Mutual, in order to work with us, insisted that we did a full KPMG audit. And that whole process really helped us get a lot of our get the ship in order, in essence. And obviously there's more to regulation than just being an auditable company, but it was almost having to dot the I's, cross the T's, really helped us get the right structures in place and the rest of it. And then we put in place a compliance team as well, who had very strong connections with the FCA. In fact, one of our compliance team members was ex-FCA, which helped us a lot with having lines into the FCA and knowing who to speak to, but also having someone who could look at what we were doing and say, well, maybe you should think about this, maybe you should think about that. That's probably not a good idea. This is going to be a problem for you. And those things really helped us when we were getting those permissions as we went forwards. And that you can do things like borrow permissions from other organizations. There's a key term for it. I can never remember what it is, but basically you come under their umbrella. They're the trusted authority or something along those lines. I can't remember the name of the term right now. And basically they have the permissions. They then agree to, in essence, license you underneath their permissions so that you can then operate. But obviously you pay them a fee for doing it. And it's not cheap, right? So ultimately you want to get your own permissions because that gives you more freedoms, more capability. But you do that over time.
I mean, from my perspective, I mean, I'm always thinking about, I've always got one eye on the budget so how do you even go about working out how to resource the activity of, being regulated in a space? Because that would just be, as you know, when you're working at your financial models, they are just that, financial models, until you actually start seeing traction, and they don't, nothing's sort of set in stone until you actually, the proof is in the eating, as it were. So then how do you then factor in and incorporate, the budget that's required to get? Is it only bringing in somebody who has that experience? What's the process for doing something like that?
That is a really, really good question, actually. And I'd say it's a combination of things. One, have some good advisors around you who've been through the process and can tell you how that costing typically works, what kind of activities you're going to have to drive, what things you're going to need to do, what your team needs to look like. Have someone on the team who's been through it and gets it and can really help with that budgeting process. The other thing is be in regular contact with the regulators and get very early indications of what that process looks like and what you need to do. There are actually some really good places now. So the FCA set up what they refer to as the regulatory sandbox in partnership with Innovate Finance a number of years ago, which really allows for new entrants into the market to operate within a safe space, even though they don't have those regulations yet. But they work with a limited supply of customers. There's certain things they can do, can't do, allows them to prove their model
so you can get
without
it right,
having to go through the burden of getting fully regulated until they're in a position to do so. So I can't tell you that every regulator offers that particular capability, but those are some of the more creative solutions you can use to resolve that problem, because it is a real chicken egg issue for some.
So basically what you're saying is try and build a relationship with the regulator and try and be as transparent as possible.
100%. I think some people were afraid to speak to the regulator because they think they're going to get shut down. That's not the regulator's job. The regulator's job is to protect customers. That's their job, right?
It's funny because sometimes as a founder, especially when you're speaking to even like you're speaking to investors, you're almost told the thing, you know, every word costs you money. But actually it's probably the opposite with the regulator. You probably want to seem to be as open and as transparent as possible.
Absolutely.
So
you don't want to be the problem child.
The
regulator. That is not the place you want to be when dealing with a regulator. The problem is when you've been operating without the appropriate controls for regulation, then that becomes a very scary place to be.
Because that's business shut down.
Absolutely. So it's about being open and transparent, but from a very early stage. Communicate with them, talk with them, get a liaison officer, find out who's the individual you should have regular communication with, and then just see where you go from there. So I know, Yon, you're in the fintech space, but you're not actually doing anything with client money.
Yes, that's correct.
At the moment.
And we took that as a conscious decision, because we knew that, you know, the extra resources that you have to put in to be regulated in that space. And you know, and when we had a small capacity, a small team,
so much you can do.
Exactly. So for us, it made sense to effectively outsource those services that required us to be regulated. So for us, we had a payments gateway, for instance. And it's interesting that you talked about essentially borrowing somebody's regulated status, and that happens very much in the fintech world. I think in particular with like PCI compliance. Because PCI compliance is how your platform or app or whatever utilizes credit card information, for instance. And if you use regulated gateways or payment providers and stuff like that, they will be PCI. They will be PCI regulated. And if you conform to their way of interacting with their platform, then you fall under their regulation and you're compliant as well. And so so we've been familiar with that, and it's very good to understand those things, because like PCI compliance, for instance, is a long, lengthy process, which costs thousands and thousands of pounds. So
you just make be very careful not to take any credit card details or store any of that. Give that to someone else. It's your problem. You can still do payments, but they're doing that piece of the pie. And that's the way you do business. Right?
Exactly. Until there's a time when, you know, your business can actually
absorb that.
And that's your actual roadmap as well, because it might not be your roadmap 100%. And it might never be your roadmap.
No, absolutely.
So this is something that's interesting. Was there a decision because Neighbour was regulated? Was there a crossroads when you could have actually taken the decision to maybe outsource the regulatory part of what you did in any way?
Well, the thing is, as a lender,
there was no way, because you handled cash.
Because we handled the cash and we did the lending. We weren't just a brokerage, right? So we did and even as a brokerage, you still have aspects that you have to focus on, right? It's just they're less onerous. But we did all the lending, so we had to be regulated. It was just, do we get regulated under the peer-to-peer permissions or just regular lending? And actually, at one point, we made the decision. It was almost made for us. It actually was made for us by the partners we were working with, who were providing institutional capital to lend. It made no sense for us to continue to be a peer-to-peer lender, at which point we just became a standard balance sheet lender, really, is what we were. So we still had to be regulated, but it meant we took a different pathway. But one of the key things about getting regulated is, like I said, it gives you optionality you might not have, and it builds in a certain value to your business as well. It doesn't always mean you're going to win, but it can be beneficial to your business to have that.
So I'm gonna take it in reverse then. So I'm gonna say, what would be, if there's, what's to say the number three or the number one thing that you definitely shouldn't do, do within a regulated space?
Ignore the regulator. Right. I mean, every regulated space is different, right? But I'd say the number one thing is, if you're not sure about it, ask. Find out. Don't just go. The idea of break it and then fix it doesn't work with regulators. They are not interested in that approach whatsoever. You can't just say, oh, we messed up this customer account, oops, sorry. Right? But they're going to get upset, right? So if you're not sure about it, find out, communicate, ask, find out who you need to talk to, get the advice and guidance, and then make a decision.
And on the converse then, what are the 3 things that you think that you should definitely do, the 3 practices that you would encourage anybody in a regulated space to do?
Firstly, get a sense of whether you need to be regulated. Right. So speak to the regulator, or speak to other companies like yours, find out whether they were regulated, whether they needed to. That's probably your first point of call. If you discover that, yes, this type of business does need to be regulated, speak to the regulator, contact them, find out what is it that we need to do. And then thirdly, make sure you've got good advisors around you who know the space and can help walk you through the pitfalls. Because even if you think you're regulated and you think you've done everything, you can still find out that there are mistakes that have been made, because they don't audit you immediately and go, okay, you have done everything. Your company is clean. You are regulated, right? It might be that there's something in there that got missed, and all of a sudden you get into trouble. So,
and you see that a lot, don't you? In the
you do, you do, especially with financial services companies. 2
years down the line, 3 years down the line,
we're seeing it already.
You didn't send a statement.
You didn't do this, you didn't do that. And they're regulated entities.
Yeah, they are regulated entities.
So I think it really comes down to those things.
And that's an interesting one, because both of us were from the financial services space. And the one thing that was always jumped into us is that, the reputational risk. So talk to us a bit about the reputational risk. I mean, what does that mean? What are the implications of
It's big in the financial service. To be fair, as a big company, you can survive reputational risk, right? You've got enough cash, enough clients that you might take a hit, but you can survive. For a smaller company, reputational risk can be devastating, because it's really your reputation that you're trading on, and that's the thing that enables you to get into these other deals. When they do their due diligence on you, if they see there's a red flag against you for XYZ reason, that could be enough for them to say, too high risk, it's not worth it, because they're already taking a risk on you as a startup. Why would they continue, right? So that regulatory risk piece is a real problem. But on top of that, you might find the regulator will no longer authorize you, right? You might find, which then means you don't have a business. You might find that you get fined and you now need to pay a significant fee to your users, or to the regulator, or reimburse cash to your users, that significantly impact the bottom line and financial health of your business, which again can end up with you having no business. So reputational risk is really important in this space, because it impacts so many things as a young company. It impacts everyone, but as a young company, it can be particularly damaging, right?
So, as I think this one has been really, really interesting.
I hope so. Everyone's falling asleep. The regulators, apart from the regulators who are listening, going, what are they up to?
So, I think actually, is there anything you would like to say? Yeah, impart on our listeners, and in particular, those startups looking to do, something really interesting and exciting in the regulatory space that you just like to give them before we go.
I guess I'd say don't be afraid to work with the regulator or in a regulated space. There are serious opportunities there, right? And if you get it right, you can do really, really well. And it's not impossible. It really is just iterative. Try again, keep working with them until you get to the result that you need. One thing I will say is don't treat the regulator as an enemy or as someone who doesn't know what they're talking about. Too many founders go, I've got this great idea. The regulator says that doesn't work. No, I'm right. We're going to try and don't do that. It's never going to work, right? So don't do it. Listen to what the regulator says. And if you need to modify your business model, do that.
Yeah. Excellent. So, Ez, I think it's a good point to wrap up there. And
brilliant.
Yeah. Please let us know if there's anything that you want to talk to us about, or you want us to talk to you about in these podcasts, and we'll be bringing on more guests in future series. So, yeah. So, guys, take it easy.
Take it easy.